Hey everyone, meet Kevin here. I think it's time to have an honest discussion about AMC. In this video, we're going to talk about how much APE AMC has sold. We're going to do some projections to try to understand the AMC valuation. We'll talk about what Amazon just announced and how much that could move the box office from a fundamentals point of view. Now look, I've been a little aggressive about APE. And I've mostly been aggressive about APE and AMC because I kind of thought that APE was a ripoff and was going to hurt a lot of people. So I sold my own APE shares and kind of told everyone it'd probably be a good idea to do that as well. And I want you to see the passion in that video clip, which I'll show you right here. Let's make this very, very clear. APE is a ploy. It is a ploy to hope that meme stock traders pump up APE stock to the moon. So that way there's a sustained market. AMC can dump shares, raise lots of money, and pay off their debt. And again, if you want a free NFT to showcase how stupid it is to hold your APE shares, make sure to go to the AMC Investor Connect website and get your free NFT. Because let me tell you, APE shares are going to be worth as much as that NFT is going to be worth. Zero. In 6 to 12 months, I expect ticker symbol APE will be worth $1 or less. That would be an 86% decline from today. And it'll be worthless and delisted soon after that. The hope is that AMC will have paid off all of their debt before APE becomes worthless. But until APE becomes worthless, AMC will continue to use it as a free money printer. And this is a brilliant farce. So I got a lot of hate from the AMC community for this. I was called a shill, a sellout, a suit. Yet I sold my APE shares at over $8 and now it's trading for $1.21. We're almost at the $1 that I predicted. And I'm not trying to pat myself on the back. I'm just trying to help people see a red flag when I see it. And people got mad at me for selling in January. In hindsight, I wish I never got back in, right? Because I was right about selling. And so when I see something fundamental, I'm not suggesting you copy me exactly or do exactly what I say. All I would say is, hey, let's have a reasonable dialogue and try to understand what's actually going on. With that said, let's talk about AMC, the movie theater. And let's talk about this Amazon deal that just came out. So we're going to incorporate these two things. First, in the last earnings, Adam Aron suggested that, hey, you know what? We've had a soft box office quarter, and so revenues declined sequentially. That means quarter over quarter. Okay. In fairness, they did. And if you put the quarter over quarter numbers in red on the left, you'd actually be able to properly compare the quarter over quarter numbers. See, we don't really want to compare to 2021 because people weren't going to movie theaters as much. We kind of want to compare quarter to quarter and maybe even back to 2019. Back in 2019, we were doing around $1 to $1.3 billion of revenue. And in Q2, it looked like we were kind of going back in that direction at about $1.16 billion of revenue. However, quarter over quarter, those revenues slipped in total 17%, and you could see how the categories have declined here. Other theater revenue down 24%. Other revenues, of course, come from those ads that you see before a movie plays and things like gift cards. Okay, then we saw operating expenses stable in Q2, which is good. We really don't want to see these explode because that would mean employee costs are going up, right? And in Q2, they were at 402.2, and in Q3, they were again stable, 400.6. Okay, good. So stable operating, the industry just shrunk a little bit. That's not necessarily AMC's fault. That's just, okay, a bad box office quarter. The biggest problem with AMC, though, is, of course, over here, corporate borrowings. Corporate borrowings went up, the expense went up by about $5 million as interest rates are increasing, and AMC refinanced some of its debt, presumably at a higher interest rate, leading to this higher interest expense in the quarter, rising from $80 million to $85.1. The operating loss, if you just consider operations, was only $16.1 million, But then when you take out other costs and depreciation and, of course, interest, you get to a total loss of $226 million. And if you want to know what kind of cash burn that is in terms of cash flows, since obviously depreciation isn't an actual cash expense, cash burn is sitting at $179.2 million, which is a little bit of a problem given that right now AMC has $684.6 million. So how do we reconcile all of this? And if you want to know the refinance information, that's actually sitting right here. They refinanced a $471 million loan at 12.75%. That, by the way, is why, yes, your interest expense is rising. So you've got a company in an industry that is somewhat shrinking. You don't actually have a lot of cash. Operating expenses are stable, and your interest expense is rising at $85 million per quarter. You actually don't have a lot of runway. In fact, if we do some quick math, we can see with $684.6 million of cash, assuming they get to a break even without touching their credit lines, they have 2 years of cash, and then they're out of cash. Then they have to start borrowing again. If you don't go break even and you keep having these negative nearly $200 million quarters, you'll be out of cash at AMC in 3 months. And then unfortunately, it's either borrow more, increasing that corporate debt expense, or it's go bankrupt. But we have to talk about this thing called APE. APE are the AMC preferred equity shares. I got a lot of heat for talking about these APE shares basically being a setup and a tool for AMC to basically just give the AMC apes, that is retail investors, something to be excited about, something to go to the moon for, something to go fight for, only to turn around and dump those shares on that retail audience using the money they raise there to pay off the debt at AMC. Now, I personally actually thought this was a pretty creative ploy, because if they could rip off retail investors, at least they would be able to pay off their debt. And if they paid off their debt, they could make sure that the 30,000 people who work at AMC don't go jobless if the company goes bankrupt. Unfortunately, the company hasn't done a really good job at ripping people off. I hate to say that because the stock has plummeted. As I unfortunately predicted, the stock has plummeted from where I sold it in the $8 range all the way to, as we see here, $1.21. But what bothers me the most is that this stock, this is the weekly chart, by the way. Let's zoom out to the day chart here so you can see this a little more. You can see with every one of these ticks representing a day, this company, AMC, had plenty of days to dump shares. All over here, look at that. You had almost you had 30 days here. 30 days that you could have sold this stock for over $5. Over $5 they could have sold this stock for and dumped on retail. And what did they decide to do instead? Well, they didn't. Instead, they decided to just sell 14.9 million shares, raising only $36.4 million, which is a drop in the bucket relative to the debt they have. $36.4 million doesn't even pay for 2 weeks of interest. It's bad. And if you divide these two, it means as of November 8th, they've been selling at a $2.44 average. Now, the stock's only worth $1.21. So they have to sell twice as many shares just to raise more money. And I think they're starting to panic because you even see that today, which is really weird, today AMC stock actually rose 4.3%. But APE stock, which usually moves in conjunction with AMC stock, fell 4%. That's really weird. And look at this massive volume boost. All of a sudden, you went from an average of 13 to 20 million shares traded, all the way to 46 million shares. That's a difference of about 25 million shares, which in fairness, if this was AMC selling, they potentially raised another Congratulations, 2 weeks worth of interest, $30 million. Except they pushed the stock more into the abyss. That's the APE shares. Now, I expect APE to be milked dry and basically become completely worthless. This is what I've been saying for a while now, but sometimes people get mad at me when I talk about fundamentals. So what am I going to do? Well, no, I'm not going to pitch you my program on fundamental analysis, stocks and psychology of money, 0 to millionaire real estate investing with a 60% off Black Friday coupon code, which comes up in a couple days. But instead, I'm going to talk dirty to you and give you some more fundamental analysis. Amazon announced today that they plan to invest $1 billion to produce 12 to 15 feature films a year that they would air in cinemas. The box office, according to Bloomberg Intelligence, is expected to grow by 18.4% in 2023 and could go up by another 15 to 20% because of Amazon. That's because in 2022, we're sitting at about $7.6 billion of a box office. That'll go up to hopefully $9 billion in 2023, and maybe even another 15 to 20% on top of that if this AMC plan comes to fruition in 2023. So, what do we want to do? Well, let's take let's take AMC's revenue and let's just average out Q2 and Q3 and let's take about $1 billion of revenue. Just to make math easy, let's just say that's about your average quarterly revenue. Let's now try to understand some future projections for this company and what the valuation of this company actually looks like. Let's grow $1 billion by 18.4% and 20%. So in other words, we're going with the best case scenarios here. Like, this is a pretty bullish scenario. That would generate about $1.4 billion of revenue for AMC. If we then subtract out the 27% that usually goes of total revenue that goes to the films, they split those revenues about 50-50 to the film companies, and we take out 65.4% for rent, food, and operating expenses. Keep in mind, the actual operating expenses last quarter were about 70.4%, but because rent should be pretty stable since you have a bunch of empty seats, I'm actually taking a whole 5% off of that margin. I'm giving them an extra 5% margin just because of the scale that they could get since they're paying rent whether the seats are full or not, right? So I feel like I'm being generous here. I'm using the biggest numbers possible on growth and the biggest growth or a larger margin here. That would leave them about $107.8 million. If we then subtract out about $85 to $82 million of debt expense, maybe even, well, I guess it would probably be like 85 to 90, somewhere around there since it's kind of trending up a little bit as they do refinances and such. That would leave about $15 to $20 million in profit per quarter for AMC in this potential best case scenario, which if you divide, just say $20 million of profit by the about 1 billion shares outstanding, which I just want to show you so you don't think I'm making these numbers up. The shares outstanding are right there. These, keep in mind, are the diluted share count, so they consider APE and all that, right? So now if we take about 15 million in profit, you'll be at about an EPS of 1.5 cents. If you take 20 million, it'll be about 2 cents. So you're somewhere between 1.5 to 2 cents of EPS. Which if we annualize that, forget seasonality for a moment, just annualize it, times 4, gets you to about 6 cents of earnings, divided by the current share price is $7, or take the share price divided by that, $7.64. You're basically, in an optimistic scenario, looking at a PE ratio of about 127 times. Which, for a company that's not a growth company, that's a startup and has really good long-term prospects, the valuation is really high, and you have to make some really optimistic scenarios to make this one work. Again, the assumptions are that box office revenues and AMC would equally benefit from that, growing at 18.4% plus 20%. Revenues about $1.4 billion per quarter. The last time, by the way, they were around $1.3 billion before the pandemic was 2019, and they actually lost money. Like, their margin was less than 2%. Except I'm assuming a 7.55% margin in this generous scenario. I don't know. Like, let's try to be positive here, but this is very, very risky. If you now add to the fact that APE is failing because they're trying to sell it, but they did it too late, like the idea to rip people off and pay off the debt was there, but they failed at it. Whew, it's just It's just not looking good. That's all I got to say. That's it. That's it. Look, is it possible that if the stock market rallies going into CPI or into 2023 as inflation comes down, is it possible that the stock meme rallies and risk rallies? Absolutely. Is it a good fundamental play? I'll leave it up to you.